this week's market update, the myth of the January barometer, what are earnings telling us, and where next for oil? Well, often at this time of year, there's a flurry of articles on various seasonal adages with names like the January effect, the January barometer, that sort of thing. The gist of them is that we can learn something about how the rest of the year will go just by looking at what happens in January. If the first month of the year is strong in market terms, so will the rest of the year be. And likewise, if January is poor, the expectation is that the year as a whole will be. Well, I've looked at this over the years and come to the conclusion that yes, there is some evidence that there's more of a correlation than pure chance would suggest. But no, it's not much use as an investment tool. It's too unpredictable to actually back with real money. Some years it works and some years it doesn't. And anyway, it encourages the wrong sort of behaviour, jumping in and out of the market when we all know that market timing is impossible to achieve with any consistency. The data I've tended to use for this analysis is based on the FTSE 100 since it was launched in 1984, which in statistical terms is quite a short period on which to base any meaningful conclusions. So I was interested to see some data from the US going back to 1900. Interestingly, they confirmed my belief that there's nothing useful in the January barometer, but it did so for a slightly different reason. The long-run US data shows that over the past 120 years, a positive January has, on average, resulted in a strong full-year outcome of plus 17.2%. If January posted a negative total return, then the return for the whole year was much worse, in fact, barely positive at all, at plus 1.7%. Now that looks like evidence that the adage seems to work, at least on average, even if probably unpredictably in any one year. But what's interesting is that if you look at the statistics for all the other months of the year, then the outcome is pretty much exactly the same. Some months the averages are even more striking. In April, for example, a positive month leads to a 19% 12-month return, while a negative April leads to a return of just 1.1% over the following year. The other months are a bit less dramatic, but in each case, the full year performance is better following a positive month than it is following a negative one. So what does this tell us? Well, probably the only useful thing we can glean from this is that the underlying trend for markets over time is upwards. That's unsurprising. Over the past 120 years, the world has got much richer, and the stock market is a kind of gauge of that improvement in our standard of living. As a consequence, there are more up years for markets than down, around 60% up and 40% down. And if you experience an up month, chances are that you're in an uptrend and the following year will be good, while a down month might suggest the market is going the other way and will continue doing so for a while. And what does this mean this year when the S&P 500 was down 5% in January? Well, it confirms what we already know, that the market has risen strongly over the last couple of years and is probably due a breather this year. Investors are looking at the economic and policy backdrop and concluding, probably rightly, that shares have gone far enough in the face of high inflation and rising interest rates. Now, importantly, this doesn't mean that shares will fall this year, but it does suggest that we shouldn't expect too much. Much will depend on how corporate earnings come through this year after last year's stunning recovery in profits. The reality is that expectations are being reined in, but not by much. The outlook today is for growth in 2022 of about 7%. At the beginning of the year, it was about 9%. That could be the sort of return we expect for shares this year if valuations stay the same. Now, whether that happens is a moot point. The good news is that shares are priced on a lower multiple of expected earnings than they were a year ago. Markets, in other words, have been pricing in the current slowdown in profits growth for some time. But that process may not have finished just yet. And if it continues for a while yet, then we should expect the total return from shares to be a bit lower than earnings growth. That's just arithmetic. So all in all, if we get a return of 5 or 6% this year, we should probably accept it as a reasonable pause for breath after a stellar rally in 2021. Looking at that same calculation in terms of the headline market level, and what it's saying is that the S&P 500 might rise from today's 4,500 to maybe 4,750 by the year end, which is where it peaked quite recently. In other words, we should lower our expectations and be a bit more defensive this year, a bit more focused on where we are invested in terms of assets and geographies, and a bit more focused on stock picking than just matching the market. So, if earnings are so important right now, how is the fourth quarter earnings season looking? Well, a mixed bag, but not bad on average, I'd say is the summary. We're now about halfway through earnings season, and still about 3/4 of companies are modestly beating expectations, despite a handful of spectacular misses recently. Last week there was a big focus on tech stocks, and your experience depended very much on which stocks you held. Shares in Facebook owner Meta, for example, fell by a quarter after a weak revenue forecast and the first evidence of declining user numbers in the company's history. Social media platform Snap fell 23% on Thursday in sympathy before bouncing back almost immediately. And we've already seen Netflix slump after it announced disappointing subscriber numbers. But look elsewhere in the sector, and the defensive qualities of tech stocks were in full evidence. Shares in Amazon surged by 15% as it became clear that advertising is becoming a profitable sideline for the company that already dominates online retail and cloud computing. It also showed the value in an inflationary environment of pricing power when it said it planned to raise the cost of its Prime subscription service. Microsoft, Google, and Apple also impressed. This week, we're still in the thick of it. There are lots of big names announcing this week, including Pfizer and Glaxo on the pharmaceuticals beat, Total and BP, which will no doubt match Shell's politically contentious profits boom from last week, a whole host of consumer stocks like Unilever, Coca-Cola, Pepsi, McDonald's and Starbucks, who will no doubt have plenty to say on rising costs, house builders Beasley and Barrett, and car makers like Honda, Nissan and Toyota. By the end of the week, therefore, we should have a pretty clear idea of how earnings were at the end of 2021 and what they're likely to deliver this year. Now, just focusing on those oil company results, they've obviously been driven by a surge in the oil price over the past 2 years from less than $20 a barrel to nearly 90. Now, that may well be the most important number for investors today because it's a key driver of the inflation rate all around the world and, by extension, the outlook for interest rates and stock markets, which have benefited so much from rock bottom rates for so long. Everything is connected. So, what is the outlook for oil? Will it keep rising to $100 and beyond? The consensus is that while we may have seen the steepest rises now, there's no particular reason for oil to fall much from these levels for 2 reasons. First, global growth remains strong. We saw that in strong job creation data in America last week, nearly 500,000 jobs created in January. Growth is expected to remain strong for the foreseeable future as critically low inventories are rebuilt and a new wave of infrastructure spending kicks in. Also, people are returning to work in force, as anyone who's been on a commuter train or driven to work can confirm. Reopening economies and more tourism promise further demand growth this year. Secondly, despite the release of production quotas by OPEC and Russia, global supply growth has been slow to catch up with rising demand. In particular, shale producers who transformed the supply-demand balance a few years ago have been slow to bounce back from the collapse in prices in 2020. All in all then, we should expect oil to stay high for the time being.